First split is between tangible and intangible. So tangible assets, think about vehicles, machines, buildings, they are depreciated, and that's it. We spread the asset useful life, we spread the cost over the useful life, and then there is a decision of whether doing a straight line, a declining balance. It doesn't really matter like the way it's depreciated. The idea is that every year you take a chunk of the expense and the asset carrying value goes down. But there is no cash out. The cash out was when you acquire the asset. Depreciation is on the accounting side. Now, when the asset is intangible, you again have another double split. Either the life is finite or there is an indefinite life. So when it is finite, it's exactly like depreciation, but it's called amortization. Conceptually, it's the same, but it's like for intangible. So you spread the cost over the useful life. And think about, for example, a patent that has an expiry life of 10 years. So it costs you 100. You're doing a straight line amortization, and every year you're taking 10 in amortization. So it's just like depreciation, exactly the same. Now, if it's indefinite, for example, a brand, the brand name can last forever, or Goodwill, then it's not amortized, it's tested for impairment. I mean, you could also have testing for impairment for finite, but again, simplification, we'll talk about, it's just the intro, we'll talk about the main ideas here, the major ideas. And quick parenthesis on Goodwill that I just mentioned. Goodwill is a special case because, and I want to take a moment on, because it's important to understand how it appears. It appears only when you acquire, or when the company acquires another company and pay more than the fair value of the identifiable net assets. So how do you get that? How does it appear? So you take the fair value of the assets, you subtract the fair value of the liability. This gives you the delta between the fair value of the net asset and the net liability will be the net identifiable assets. And let's say this is worth 100, but the company to acquire this other company has paid 200. So the difference between the 200 and the 100 is goodwill. It could be, for example, because we think there will be synergy, or there is customer relationship, or whatever. And it sits on the balance sheet until proven otherwise. And this until proven otherwise is the impairment test. At least once a year, or whenever there is an indication of something changing, management and auditors will ask, is it still worth $100? And for that, goodwill is allocated to cash generating units and compared to recoverable amount, which is the higher of the value in use, the present value of future cash flow, and the fair value minus the cost to sell. On the US GAAP, it's done in 2 steps. It's written right here on the right side of the slide. But it's basically more or less the same idea.